Started here. Welcome to those that are here in person and those that are with us in the Zoom and those that are watching the recording afterwards. Very happy today to have Lars Olson, President, Wealth Advisor of Alluvial Private Wealth, here today to talk to us about the primary uses of deferred compensation, non-qualified deferred compensation plans. In an increasingly competitive labor market, nonprofit organizations may be interested in different strategies to attract and retain top talent. The non-qualified deferred compensation plan can be a very flexible and targeted benefit to attract and retain top talent. And I guess with that, I'll hand it right over to Lars for the rest of the presentation.
Thank you very much, Matt. I appreciate it. Just to double check, Raymond, can you hear me okay? Okay, perfect. Good deal. Thank you so much. So what we want to talk about here today would be about non-qualified deferred compensation plans. And what I guess I figured I would start out by doing is by talking about what non-qualified deferred compensation plans, what we're not going to talk about first, and then we'll talk about the deferred compensation plans. Okay. So in terms of financial planning, right, and what we're going to talk about, we're not going to talk about individual retirement accounts or IRAs. Okay, an IRA is an individual account that's set up by an individual. It's not set up by a company. IRAs are very important and very beneficial building blocks for financial planning. You can save $6,000 into an IRA if you're under age 50. You can save $7,000 a year if you're over age 50 in a tax qualified fashion, either a traditional, which gives you some tax benefits today, or a Roth, which gives you tax-free growth in the future. I encourage people to have individual retirement accounts, but we're not going to talk about those today because we're only going to talk about group plans. We're also not going to talk about qualified plans. We're only going to talk about the non-qualified plans. So what's the difference? A qualified plan has met certain qualifications under the ERISA Act of 1974. Now, some people think that ERISA stands for every rotten idea since Adam. But actually, it's the Employee Retirement Income Security Act of 1974. And what it lays out is a number of different guidelines to protect employees for things like participation, vesting schedules, benefits accrual, funding, and plan information. And so plans that meet these minimum guidelines can be tax qualified and can have some extra benefits. Two of the most popular categories of ERISA qualified plans would be a pension plan, also known as a defined benefit plan. And a defined benefit pension plan would be something which was very, very popular in the 70s and the 80s, but has become a lot less popular now. What a pension plan does is it guarantees, minimum income, typically on a monthly basis for the life of the employee. And the employer bears all of the risk. So that's what a pension plan is. A non-qualified plan that we're going to talk about today is not a pension plan. And we're also going to contrast this to a defined contribution plan or a 401k or a 403b. That's also a different type of a plan. That's a qualified plan. Now, unlike a defined benefit plan, which gives you a defined income or a benefit at your retirement, a defined contribution plan doesn't have a specified benefit at your retirement. It only has a specified contribution that can go into the plan. So with a 401k as an example, and you can go ahead and put in $19,500 if you're under age 50 years old. For those of y'all like me who are over 50 now, we can put in $26,000 a year. That's what the employee can put in. That's a defined amount, and you can't go over that amount. The employer can also make matching contributions. The employer can make additional contributions, but the employee can't put in any more than that. So we're not going to talk that much other than to contrast, right? These qualified plans. We're going to talk about a non-qualified plan that has not met these different guidelines for ERISA and which therefore presents some very unique opportunities for charities that might want to go ahead and recruit and retain top talent. And so let's go ahead and dive in, if it's all right. So the first question then again is sort of what is a deferred compensation plan? It is an employer-sponsored benefit. So again, it's sponsored by the employer. It's not an individual retirement account that the individual sets up. The employer sets it up. And it's basically an agreement between you and your employees. And those folks who participate in the non-qualified deferred compensation plan can defer some of their annual income before taxes are due. And the employer then promises to distribute out that money plus any earnings and plus any employer contributions in the future to the employee. So again, there's some very unique cases that we're going to talk about, which are great benefits for charitable organizations, particularly on these deferred compensation plans. So what we're going to go ahead and cover today, we're going to go ahead and cover 4 key items. And so, sorry, we'll just go to the next slide.
Try again.
What's that?
Try again.
Oh, sure. Oops. There we go. So the first thing we're going to cover is we'll talk a bit about how non-qualified deferred compensation plans can help employees, particularly key employees of the charitable organizations, save more money. We're going to talk about how it can be a benefit to help the employee manage the timing of either their income or else the taxes that are going to be owed. We're going to talk about how you can use it to recruit, retain, reward, and help key employees retire. And then finally, we're going to talk about one additional item where how they are very flexible and it can simulate employee ownership, not as pertinent for a charitable organization. I know that, but it's just an illustration of how flexible these plans can be. Okay, so the discussion here, a lot of it's going to focus in on how these plans can help key employees. Okay, so these may be plans that you haven't necessarily heard a whole lot about. They're not that common. Matt was kind enough to share with me, the Ohio Association of Nonprofit Organizations Compensation and Benefits Survey. And in the 2021 survey, there's only 6% of respondents said that they had a non-qualified deferred compensation plan in place for their key executives. And only 3% of charitable organizations had one of these plans in place for all employees. And so they're very unusual. And if you haven't heard of them, you're not alone. They're quite different, but they can be very helpful in a tremendously competitive work environment. So, let's talk about how competitive the work environment is, right? We know this, right? There's labor shortages that are out there. Millennials are known as the job hopping generation, those that are born between 1980 and 1996. 6 in 10 millennials, according to a recent Gallup poll, said that they are open to new opportunities. And 21% say that they have actually changed jobs in the last year. By the way, that Gallup poll was before, right, the great resignation that we're seeing right now. And this great resignation is one where an August 2021 survey from Bankrate found that 55% of people in the workforce, no matter what generation, 55% of the people in the workforce are looking for a new job in the next 12 months. So we have a tremendously competitive work environment, and these non-qualified deferred compensation plans can be particularly helpful for retaining key employees and attracting key employees. And that's the first use we're going to talk about. Now, in terms of surveys, Principal did a survey of non-qualified deferred compensation plan participants, and they found that 92% of participants said that the deferred comp plan is important in helping them to reach their retirement goals. All right, now I'm going to grant you this is a very targeted survey, right? Again, most people don't have a non-qualified deferred compensation plan to begin with. So this isn't everybody that's out there, but those who actually do participate in it see great value in it. That's the point. Those who participate see great value in it. Now, what is the value that they can have? The non-qualified deferred compensation plan can help your key executives go ahead and close the retirement gap. Okay, so what's the retirement gap? As you'll see on this slide, you've got a green area, and the green area refers to how much Social Security should be replacing as a percentage of a typical retiree's income. Okay, so on the left-hand side, you'll see that if your current income is relatively lower, if you're in a lower income bracket, Social Security might replace, let's say, 30 or perhaps even 40% of your wages. Now, it's not going to replace 100%, but it replaces quite a bit. Now, as you increase in wages, Social Security replaces a smaller and smaller percentage of your income. And that's for a number of different reasons, including that the Social Security wage maximum is $142,000. And for a number of charities, their chief executive officer might be earning more than that, but their Social Security wage taxes are capped at that level. The maximum benefit in 2021 for Social Security, if a person was going to retire with having had maximum earnings each year during their working career, would be $46,740 a year. So if somebody earns 150, that's around a 30% replacement rate. If somebody earns 200, that's a 23% replacement rate. You can see that the more income that your current chief executive officer earns, the lower percentage of replacement income Social Security provides. Okay, well, our company, our organization, our charity has got a 401k, right? We've got a 403b. We've got ways for the individual to go ahead and to provide for their own retirement, right? Yes, you do. And that absolutely helps. But as I mentioned before, there's limits with a defined contribution 401k plan on how much you can put in to the 401k plan. It's $19,500 in 2021 if you're under age 50. It's $26,000 a year if you're over age 50. And so there's a limited amount that can be contributed into the 401k plan. And so that limited amount, again, as the wages of the chief executive officer are higher, right, that limited amount represents a smaller percentage of a replacement. So there's this gap, and that gap filled by something like a deferred compensation plan for your chief officers, for your top executives, your highest paid employees. Now, as it relates to this, as it relates to the 401ks, I say that the chief executive can put in $26,000. That's the maximum dollar limit, but actually they might be limited more than that. And let's just talk for a quick minute about that. In terms of 401ks are qualified plans which require non-discrimination testing to take place. The non-discrimination testing is called the ADP test, the actual deferral percentage test, and the ACP test. So there are two different tests to look at if the plan is a fair plan that allows for both highly compensated employees and non-highly compensated employees to benefit in a reasonable parity on the plan. And the non-discrimination test basically says that your highly compensated employees cannot be contributing more than a 2 percentage point rate higher than your non-highly compensated employees. So if your non-highly compensated employees, if your rank and file are contributing 3% of their salary into a 401k, then the discrimination testing generally says that the highly compensated employees would be limited to a 5% contribution rate. Forget about the 19.5, forget about the $26,000, 5%. Based upon the discrimination testing. So, with regards to the 401k, it may not be as good of a benefit as you might think for the highly compensated employees. What is a highly compensated employee? Someone who in 2021 is earning over $130,000 a year at your charity is considered a highly compensated employee. Next year, the number goes to $135,000. So that's what the definition of a highly compensated employee is. Now, if the 401k goes ahead and fails the non-discrimination testing, there's some ways that you can go ahead and remedy things. One of them is to make it what's called a safe harbor plan, but that could be expensive. Or you can refund to the highly compensated employees the excess contributions. So for 401ks, they're not necessarily as great of a benefit as you might think for some highly compensated employees. If you're a chair, sometimes a 403b is a lot better because it doesn't have the same type of non-discrimination testing as the 401k does. Next, let's talk a little bit about, beyond the 401k restoration. Non-qualified plans offer some great flexibility because they can be very, very flexible in terms of deferral contribution amounts, right? Where I mentioned the 19,500 and the 26,000 as limits for the 401k. Theoretically, you can have a much higher deferral limit for a non-qualified, or the highly compensated employee might be able to defer 100%. The non-qualified deferred compensation plan allows for the company, the charity, to make contributions into the key executives plan as well. And there's the opportunity to have this benefit be very targeted to selected key employees to try to reward and encourage those key employees. And then additionally, there is a vesting schedule which can protect the charity. So the first part about the deferred compensation plan is that it allows for greater savings in retirement. The second part is that it helps organizations and individuals to manage the timing of income and taxes. And look, timing can be very, very important in terms of when an employee wants to receive funds based on certain life events, and then also based upon how tax rates may be changing. So let's talk first a little bit about sort of tax timing. You know, the non-qualified deferred compensation plan would allow an individual to defer compensation from 1 year into a future year, at which point in time, perhaps income tax rates overall are lower, or perhaps the individual situation might have changed, like they went into retirement, and therefore they have a lower income, and therefore they have a lower tax rate. So the individuals can go ahead, the employees can go ahead and time their distributions based upon when's most beneficial for them. You can coordinate, the employee can coordinate the timing of the benefits with Social Security. Look, as a financial planner, I'll oftentimes recommend to clients that they defer the receipt of their Social Security benefit, because for every year that you defer the benefit of your Social Security, you get about an 8% increase guaranteed on your Social Security benefit. It's phenomenal. So we encourage a lot of people, if they can, to defer all the way to age 70 years old, the maximum benefit. Well, the non-qualified deferred compensation plan can fill in those years to allow for that deferral for the Social Security benefit to be maximized. Additionally, as it relates to retirement accounts, IRA accounts, 401k accounts, the government forces a required distribution at age 72, but prior to age 72, you don't have to take money out of the IRA. It might be more beneficial to leave that monies in order to be able to grow. And so the non-qualified deferred compensation plan allows for greater flexibility based upon the employee's own situation and need. Now, please note, I'm not a CPA and I did not sleep at a Holiday Inn Express last night, so I don't have all the answers. Talk with your CPA about tax questions. But I do share with you that it allows for the opportunity for some neat timing. Now, let's just look at one quick little bit of an example, if it's all right. So here's an example which shows an individual who had $120,000 worth of a base pay, and they chose to go ahead and defer 10% of the base pay plus a portion of a bonus for a total of $32,000. The numbers are what the numbers are. You can use whatever numbers you want. The point is about the baskets. The first basket shows Mary's college fund, where monies are coming due in just a couple of years in order to pay for a child's college education. And so, you know, the deferred compensation can be timed for when your child hits certain milestones. I actually did it for my own daughter, Lena. And so, you know, we've got 4 years worth of college, you know, that monies will be coming through in order to help to pay for those. Now, you can also manage how you invest those monies. You'll see in green, it says that particular portfolio was managed in a conservative fashion because it's coming closer. And you don't want to say to your daughter that hey, you can't go to college, the market's down. That portfolio could be managed in a more conservative fashion. Michael's college and a beach house, which are further out, can be managed in a more moderate risk tolerance fashion. And then monies that would be coming through for retirement could be managed in an even more aggressive fashion. But the point is, you can have multiple different buckets to allow the key employees to be able to meet their goals and obligations, and it's a very flexible tool. Now, additionally, it should be mentioned on 401ks, there are some highly compensated employees where if the plan fails the termination test, where you've got to return the 401k contributions to the employees. And so this is the sort of thing which the deferred compensation plan can go ahead and be a solution for that issue for the highly compensated employees. Let's talk for a minute or two about vesting. Vesting refers to what is the point in time at which the employee actually receives the monies, and frankly, therefore, is also taxed on the monies. So on this example, you'll see the sample forward rolling vesting schedule where the monies were deferred in 2021, paid then in 2024, earned in 2022, deferred in 2022, paid out in 2025, and so forth. So this is a sample of a rolling vesting schedule where the employee is pushing out their distributions 3 years down the road. Now, this is important for a couple of reasons. Why again would the employee want to go ahead and do this type of a rolling schedule? Better manage their taxes, better go ahead and cover future defined costs like college, retirement, whatever. Why would the employer be interested in this type of a rolling schedule? Well, I had mentioned to you that the employer can also make contributions into the employee's non-qualified deferred compensation plan. And you'll see on the little diagram here, you'll see golden handcuffs. Okay, so in terms of the non-qualified deferred compensation plan, these can be used as golden handcuffs to help retain top talent. Okay, I had been on the board of a charity and we established this type of a non-qualified deferred compensation plan with a rolling 5-year vesting schedule to better retain our outstanding chief executive officer. In this particular case with that chief executive officer, the monies that got put into the plan were monies that she could see, but she was not vested on. And so after 2 and 3 and 4 years, there was a sizable pool of money that was there, which was keeping that chief executive officer tied to the charity. And if there was another charity that was going to come and try to steal her away from us, we knew that that other charity would probably have to then, match or meet that cost in order to steal away our outstanding chief executive officer. And so it was a way to be able to better retain and reward an outstanding leader. By the way, what would have happened if she would have left prior to that time? Well, any unvested balances on the non-qualified deferred compensation plan go back to the company if it was the company's money. If it was the employee's money, it's theirs. If it was the company's money, it comes back to the company, to the charity, right? So in that sense, again, it was a great way to have some golden handcuffs to be able to retain the leader. Now, we'll move a little bit more into this notion of sort of recruiting, retaining, and rewarding key employees. And on the retaining and recruiting, on this document that Matt shared with me as well, I just would mention a couple of other interesting statistics. The turnover for employees in nonprofit organizations that were surveyed was quite high. Would you like to guess what the turnover was, for nonprofit organizations in Ohio last year and in 2019?
40.
Not quite 40%. You're a little pessimistic. The number actually was about 16% in both of those 2 years, which is a very high amount of turnover. Now, with regards to the organizations that were surveyed, excuse me, 75% of the organizations said that they did not have any sort of a bonus or incentive pay plan outstanding. And while compensation is not the number one reason why a person works in the nonprofit sector, those that were surveyed said that up to 25% of the turnover was compensation related. So it's not de minimis, right? It's a meaningful and it's important thing to consider. How can we best go ahead and hold on to our top talent? So, again, the non-qualified deferred compensation plan might be a way that is a very flexible way for you to go ahead and give back to employees and also to better retain leadership. It's very flexible for different stages in people's lives. And it's something which can be put together with different sort of criteria to motivate performance. In the situation that I mentioned where I was on the board of directors, we actually had a contract between ourselves and the employee, which described certain ranges that she might be paid based upon performance achievement. And so again, it's a contract, and it's something which can lead to performance rewards for employees. In terms of recruiting new employees, that's another possibility that's out there. And you could attract top talent by assigning bonuses tied to tenure or performance. Again, to be able to better protect the organization and avoid a situation where after the check is cashed, the key employee is at risk. You can better retain top talent throughout the organization. You can reward performance in a way other than a simple cash bonus, and you can help your key employees go ahead and better prepare for their own retirement as well. Now, in terms of the flexibility of the plans, I would just highlight for you here a few quick comments. This is more appropriate for the for-profit world rather than the not-for-profit world, because of course there's no ownership in non-for-profit. But I wanted to at least give a tiny bit about the flexibility here on the non-qualified deferred compensation plans. And so, the non-qualified deferred compensation plans can provide different types of incentives based upon a variety of different metrics that might lead to an ownership-like experience of a division or of a category. The non-qualified deferred compensation plan, you can go ahead and create, performance-driven benefits. And from a transition planning standpoint, it can help with transitioning as well. The sale is not important for nonprofits. Now, more than 3 in 4 nonprofit plan sponsors are concerned about losing key employees to their competitors. This was done based upon a Principal 2020 study, and it's before the great resignation, which we're seeing right now. I wonder how those numbers would look now. I have a strong feeling that it's probably a heck of a lot more than just 3 in 4 saying that these types of plans are beneficial. So, to sort of begin the wrap up, and then if there's any questions, I'd love to be able to help with any questions. But some of the key benefits that are out there as it relates to the non-qualified deferred compensation plan, it helps the organization to recruit, retain, and reward employees. It allows for not only contributions from the employee, but it also allows for contributions from the employer. It allows for employees who might be prevented from making their full 401k contributions to be able to make a bigger contribution. And it's easier to administer because there's no discrimination testing, there's no minimum participation requirements, no 5500 filing. And if it's set up, and it can be limited to just your key employees. And some of the key benefits for participants, you can take better advantage of pre-tax deferrals, tax deferred growth, and compounding. You can defer up to 100% of compensation. You can design your own investment strategy, and you can enjoy flexibility within the plan design because they're not subjected to the same sort of age restrictions as a 401k plan. So for example, if a person is under 59 and a half, right, before normal retirement age, you could set it up where your distributions from the non-qualified deferred compensation plan come out, and they're not subjected to the 10% penalty that you'd normally have to pay if it was a distribution from a 401k or a qualified plan. So there's a lot of benefits that are out there. I would just note for you, there's also some very creative design plans that are out there, including some that are involving what are called split dollar plans. And Ohio Health is a charitable organization that actually just rolled out a major plan for their doctors as well as key executives, which involves this type of non-qualified deferred compensation structure. So there's a lot of creativity that can be done for the benefit of employees and also to help an organization retain top talent. Now, I know I've done an awful lot of talking. If there's any questions, I'd love to be able to help and answer.
Thank you. Yeah.
We have no employees in our organization. We are totally volunteer based, so there is no exchange of payroll.
And for a lot of organizations, it may not fit, but there's some organizations where it could be a fit.
When I retired from teaching, I had a third comp plan in my employer there. Yeah, it was very helpful.
Yeah.
Lars, you mentioned if the employee were to leave before the vesting, the money you said would go, the company or the organization put in would come back to them. Does that include, like, I guess, would it be interest or any tax-related penalties or something that would come back on where would that shake out in terms of the split there between the employee and the organization?
So if the contributions are from the employer, then contributions will be coming back if the employee is not fully vested. Absolutely, yes. Now, with regards to these types of plans, there are two general types that are done. I recommend, and I'm most familiar with what are called funded plans, where there's an actual account that would be set up, which would be in the name of the organization, not in the name of the employee, which would be in the name of the organization, which would then receive funds and could be invested into mutual funds. And so then that is an investment account for the charity, right? Which every year is generating a 1099. And if it's a tax-free organization, if it's a 501c3 organization, it wouldn't be paying the taxes on it. If it's a for-profit organization, then the company is paying the taxes every year on that account. If the employee would go ahead and leave before the vesting schedule, the company simply keeps the money that they contributed plus the growth that was their contributions, not the employee's deferred compensation, but the company's contributions, charity's contributions.
And then in terms of this benefit compared to other benefits, if you're a smaller nonprofit, maybe this is one of the tools you use, but in your opinion, what are some of the most utilized, or should be some of the most utilized benefits that nonprofits should take advantage of when they're trying to attract talent? Is it this? Is it what are the steps you usually recommend when you're talking to someone about how do we make ourselves more, I guess, attractive to top talent? What are some of the things we absolutely should put in place?
Yeah. So, I mean, in terms of different types of company-sponsored plans, they're going to range from very simple and easy to administer, right, up towards the more complex and expensive. And I think it's wise to start off with some of the more basic building blocks, right? And from a financial planning standpoint, we encourage, for example, folks to do IRA accounts. For very small organizations, we encourage organizations to look at simple plans. You've got to have less than 100 employees to do a simple plan, but it's something which is very easy to administer and relatively low cost to put in place. There's no administrative cost on the part of the organization. All of the costs are borne by the individual employee's account, but there is a required match from the employer to the employee. We keep moving forward as a sort of complexity next week for charitable organizations in particular, like 403B accounts. Charities can also do a 401k account as well. Now, you don't have to do a match, but we do see most plans having a safe harbor match because that eliminates the issue of the non-discrimination testing if you have a safe harbor match. What a safe harbor match is for a 401k is that the employee contributions are matched dollar for dollar up to the first 3% of compensation, 50 cents on the dollar for the next 2% of compensation. So if the employee puts in 5, the organization's got to match 4. So that's what a safe harbor plan would be. And the safe harbor plan also involves immediate vesting. So it does not allow for employers to go ahead and claw back money from employees who leave too quickly. There's immediate vesting. So there's some drawbacks on the safe harbor plan, but in terms of the building blocks, those are the easiest ones to do. Now, if you're looking at a charitable organization that's got some highly compensated employees where you might have that issue of discrimination testing, where you might have that issue where the highly compensated employee can't go ahead and fully participate, or you know, in a competitive job market, you need to go ahead and compete more, the non-qualified deferred compensation plan is a great fit. But I would recommend going from simple up the ladder to the more complex. This is definitely in the category of more complex. If you don't have a 401k or a 403b, start with a 403b. Don't start with the non-qualified deferred compensation plan.
I have 2 questions just to follow up on Matt's point. On the vesting, you had an average of 3 years. Can that be more than 3 years in terms of vesting?
Yes. Yes.
Okay. Can it? So So in terms of attracting higher talent, can it be less than 3 years?
The answer is, I believe that it can be less than 3 years, but I will have to double check for you.
Okay, great.
The ones that I'm most familiar with have been in the 5-year category. It's enough that allows for the employee to be tied to the organization for a reasonable period of time, right? But not so long that the employee figures I'm never going to get these monies. What's the point?
Exactly. And in terms of the employer matching, you said it's around 3%. Can it be more so that you kind of stand out from the rest? Or is that a standard that can be broken?
So it's a good question that you're asking. So as I understand the question, you're saying on the employer match of 3%,
yep.
Can you do more than that? So on the non-qualified deferred compensation plan, it is very, very flexible in terms of what the organization chooses to put in. So you don't have to necessarily match at all.
Right.
And you could just use this purely as golden handcuffs. When I was on the board of directors of a charity, what we did for our chief executive officer was we did not allow the chief executive officer to put in her own money into the plan. This was purely money from the organization that was there for her, and it was in excess of 3% of her compensation. So
Okay.
If an organization wants to stand out and step up and really, appear aggressive as far as recruiting top talent, yes, this is a very flexible tool to do that.
Excellent. Thank you.
What's more typical, both sides putting money into it, or more than what you just described, or it's just the organization putting funds into it?
So we've seen both. Okay, so for example, with an organization like Ohio Health, they've got an awful lot of highly compensated employees, the doctors and the executive staff and so forth, that want to go ahead and be able to set aside more money. And if you think about what Ohio Health does as an organization, theoretically, their competition would be the doctors going into private practice, right, where they're their own business owner. So they wanted to be able to try to give an opportunity for more of that ownership-like experience that I went through relatively quickly, because I didn't think it applied to a lot of our attendees here today. So if there's an organization where there's a large pool of highly compensated employees, then allowing the employee contribution is something that is expected. Yes. Now, if it's a smaller organization where there's maybe a smaller group of highly compensated employees, or you really want to be targeted, and that CEO that you have is truly outstanding, and you want to retain that individual, that's where the company contribution by itself would come in instead.
Cool.
Lars, you use the term charity in talking about the nonprofits, which are 501c3s. Well, what about 501c6, which are not charitable?
Like the chamber.
So, I'm going to defer to the CPA, but I'm going to guess on this one. Chamber, well, C6. Do you pay taxes each year?
Yeah.
So on that investment account that a C6 might have, which is an investment pool for the top executive, as that investment account earns a rate of return, the C6 would have to pay taxes on it every year. That's the key difference.
Yeah.
Whereas a 501c3 would not. But it would be something that could be established nonetheless, just different tax implication. And maybe that would lead the C6 to want to buy mutual funds that are more tax efficient, whereas a C3 wouldn't care if the mutual fund distributes big capital gains or not. Who cares? Just as long as it's earning a decent rate of return. Yep. Great question.
I think that's on. I didn't see anything come up in the chat, so I thank you, Raymond. I think that takes care of our questions. Any closing thoughts, Lars?
No, I appreciate the opportunity to be able to share some comments and appreciate the partnership with the Chamber of Commerce. We're a relatively new business here in Marion, Ohio. I've been a financial advisor for been in financial services business for 26 years, but for the last 1 year, a small business owner here in Marion, and we love the opportunity to partner with the Chamber.
Very happy to have you, Lars, as always, and you've been an amazing partner for many, many years. And we're happy to have Alluvial now, even downtown. That's all excellent. Feel free to stop by their office, and it's in the MTC downtown building as well. I'll be sharing the slides from today's presentation and the recording posted later for those watching it. Thanks for watching. And gosh, we will see Nonprofit Exec Council in February of 2022. So hopefully everyone has a safe and happy holidays, and thank you very much for coming. Thank you.
Thank you.
And you're here. Bye, Raymond.